Hello, everyone. Thank you for joining today's web conference, the CNR March 2024 Market Update. My name is Reagan Stanfield, and I'm a Business Development Specialist at City National Rockdale. Today, I'm joined by City National Rockdale CIO Tom Galvin, Managing Director, Senior Economist, Senior Portfolio Manager Paul Single, and Senior Portfolio Manager, Senior Equity Analyst, David Shapiro. The views and estimates that you hear today are sourced from our investment committee's weekly meetings. During today's call, our presenters will share their perspective on the sustainability of the bull market and opportunities for equity investors in the quarters ahead. Topics to be explored include, will U.S. equities continue to outperform? Are tech stocks in a bubble? Will market leadership broaden? And how is CNR positioning portfolios? At the end of the presentation, we will all be on the line to answer questions we received from you during the webinar. A few logistics before we get started. We welcome your questions, so please type them into your console's Q&A window anytime during this session. If you would like a copy of the presentation slides, you can download them in the resource window. To invite Paul Single to begin the call with a quick update to CNR's outlook. Paul, can you share with us any changes since the last webinar in February?
Yes, I can. Thank you so much, Reagan. We've upgraded our view of the economy. This page, of course, has our highlights and the more prominent topics that we want to focus on are in bold right now. But in terms of the economic outlook, we've moved in terms of our view of a risk of a recession, and that's been dropped down to just 30%. So the probability of a soft landing or a slower pace of growth is now at 70%. Last month, it was at 60%. The month before, it was at 50%. And the reason why we've become far more optimistic in terms of our view of the economy really has to do with two things. First off, the Fed has increased its tolerance for the high level of inflation that we've seen at the beginning of the year. And they've also said that they expect inflation to be a little bit higher this year. So again, it's another measurement of the fact that the Fed will tolerate the higher levels of inflation because they still view that inflation will move down by 2025 and in 2026. The other issue really has to do with the resiliency of the U.S. economy. Employment growth continues to be quite strong, and consumer spending in the third and fourth quarter of last year were at very, very strong levels. And that will continue into this year. Won't be as strong, but we'll continue to see the strong spending. Yet at the same time, the Fed is committed to continuing to cut interest rates 3 times this year. We're not as optimistic as the Fed is. We think it's going to be 2 or 3 times, but that will really depend on how the inflation number plays out over the next several months. In terms of the investment strategy, we expect modest returns across asset classes this year. Small cap equities appear to be increasingly attractive for those that are looking for additional capital appreciation. Most importantly, we continue to avoid international equities for now. Many of the other developed countries are near or at recessionary levels. And of course, they have higher risks of geopolitical concerns than the United States does. In terms of our view of what we've changed from last month, we've upgraded the outlook for GDP. We now expect GDP to be a little bit stronger. You can see here on the top right-hand side, it's between 1.5% and 2.25% for this year. That's a little bit better than what we saw beforehand. Last month, that number was at 1% and 2%. So we've narrowed the range a little bit going forward. And corporate profits are much stronger. We've pushed up the lower end of that to 9% from 6%. The top side continues to stay at 12% going forward. In terms of the risk of a recession, as I mentioned earlier, we've pushed that down to 30%. And you can see here on the chart on the left-hand side that we're now below market consensus in regards to the probability of a recession happening in the near future. As for our speedometers, last month we did move forward an awful lot of them into the green territory, but we continue to believe that we'll see higher levels of economic growth this year. And you can see here on these that a number of them have been focused in terms of just a slight bit more attractive. Again, because of the resiliency of the American consumer and because the Fed will be lowering interest rates, making borrowing money a little bit easier and more attractive for those that want to do so. In regards to the Fed, there's probably a question there, is there?
Yeah, so the question we had here, Paul, the Fed met last week, and it seems that rate cuts are still on the way, but the timing is a bit uncertain. What is CNR's view?
Yeah, the Fed, it was quite interesting in terms of their outlook for the economy. The chart here on the left shows GDP. The dark blue line is history. And the columns that you see are the forecasts that they have. The lighter blue is what they were saying back in December, and the darker blue is what they're saying now. So you can see there was a big upgrade in their economic outlook in terms of GDP, moving from 1.4% this year to 2.1%. That's a 50% increase. For the following years, just subtle changes. But the interesting thing is the inflation that you see here on the right-hand side. Here we're looking at core PCE, not CPI, because it's PCE and core PCE that the Fed focuses on heavily. They expected we won't see as much of a disinflation story this year as we saw last year. And so they expect the level to be just 0.2% higher than what they thought back in December. Again, this is just playing into the tolerance that the Fed had talked about. This next chart just shows in terms of the expectations for the federal funds rate this year in terms of what we're thinking. As I mentioned earlier, we think it'll be between 2 to 3 cuts this year. And it's now close to what the market consensus is. And you can see that with the yellow gold color line that's there right about at the same level. The green is what the market was saying back in December, where they were expecting far more cuts in the Fed funds rate, which is sort of funny because that's the same time that the Fed said that they were only going to do 3 cuts. But the market thought that they knew better. But as time has gone on since December, we've seen a much stronger pace of economic growth, much higher inflation. So the market's expectation has moved back towards what the Fed thinks and, of course, what we also think.
Thank you, Paul. When you were highlighting the speedometers earlier, you spoke about the positive changes made for the consumer outlook. What about the investment side of the economy?
Yeah, that's a very important question. You know, when you look at the components of GDP, this chart, I think, does a nice job of showing a little different perspective of what people think about when the quarterly GDP data comes out. Goes from 2000 to the present. The shaded area is overall GDP. And the 3 lines are the more prominent parts of GDP in terms of components. We took the trade ones out because they're extraordinarily volatile and they don't really tell much of a story. But what's interesting here is the dark blue line is consumption, which is the biggest part of GDP. That's pretty linear, you know, which is interesting because everyone's focused on that number each quarter. But take a look at the other components. Government is a little bit more cyclical in the gray, but the investment part, the one that you're asking the question about, the light blue that's there, that one's even more cyclical. So for an investor, this one provides a lot more opportunity to try and find ways to capitalize on this volatility. The chart here on the left, the dark blue line that you see is focusing on the investment part. The label is incorrect, but the dark blue line is the intellectual property aspect of this component. And over on the right-hand side, the more important part is taking a look at the intellectual property component, which is the shaded area, and looking at the 3 subcomponents within it. And you can see that there's been tremendous amount of opportunity there, mainly based heavily on the tech sector. On the left-hand side, you can see the chips or microchip manufacturing that's been going on in the United States and what the strength has been, it's unbelievably strong in terms of what we've seen. What's interesting is that the demand has been a whole lot higher. So in the United States, for example, you can see this growth that's gone on, but the amount of chips that the United States manufactures is only about 10% of the world's demand. If you go back to the 1990s, it was about a third. So this is the reason why we're starting to see changes go on, especially from the federal government, in terms of creating more chip making here in the United States. A lot of it's designed here, especially the complicated chips, but they've been manufactured overseas, especially like in Taiwan. So that's why we have the CHIPS Act to try and help out in terms of economic potential and in terms of for defense. The right-hand side that you can see here is a little bit more detail in terms of the industrial production part of these industries. And you can see the upward trend is helping to drive growth even more in this sector. So in terms of overall economic growth, the investment portion of GDP is, our view, is going to be a very strong proponent and help drive growth at a much faster pace. And of course, that creates an awful lot of great investment opportunities.
Thank you, Paul. That was very informative. Tom, I wanted to turn the next question over to you. CNR has a long-standing preference for U.S. equities. How does that relate to what Paul just spoke about?
Yeah, so let me dive in and answer that question in a couple of ways, Reagan. Firstly, in the past, you've likely heard me talk about our proprietary 4 Ps framework, which reflects our views of what we believe are the 4 most important factors for regions of the world to gain and sustain a competitive advantage. They are policy, population, profitability, and lastly, this slide, the potential for innovation, primarily in industries of high intellectual property. Now, this slide is a deeper dive into this potential for innovation factor and the 5 subcomponents that make up the final ranking. This ranking system has inputs from a number of leading market research firms. So if a country has an input that's number 1, we rank it as number 1. So think of it as a golf score, the lower, the better, or think of it as a March Madness bracket. Where would you want to place your investments? On the top seed number 1, or roll the dice with an upset from some other country and area of the world? So on all these measures that we show here, R&D as percent of GDP, patents, the quality of our venture capital community and the university system, the overall global innovation, we are by far number in the world, and it isn't even close. So as a result, both the U.S. stock market, the S&P 500, the U.S. economy has had significant advantages in this information age that we live in. This advantage is shown here on this slide. On the right side, you could see that S&P return on equity is significantly higher than non-U.S. developed markets as expressed by the EFA index. This is a result of a lot of factors, the high quality healthcare and tech companies that we have. Also, our multinational corporations are more competitive versus their global counterparts. They have more innovative approaches to their business model and their financial capital management metrics. So this higher ROE combined with our proprietary 4 Ps framework has been a foundational reason for our longstanding emphasis on equity investing in the US and not overseas. This slide shows a couple of things. On the right side, it shows performance, and on the left side, it shows the composition of the indices. So as I see it, the mistake that many investors make is that to have diversification for the sake of diversification, what you end up happening to get is diversification. So you can see on the right side, the US industries have strongly outperformed non-US, up 15% versus 7%, S&P 500 versus EFA, and only 2% over the last 5 years for emerging markets over in Asia. Now, part of the reason is the composition of the indices on the left is very different. In the S&P, the secular growth sectors, such as tech and healthcare, represent approximately 42% of the S&P 500. And that's compared to 22% in non-US developed. For the EFA index, as we see it, to outperform the S&P 500 on a sustained basis, emphasis on sustained, not these periodic moments in time when they'll outperform, you need two things to fall into place. The first would be a faster sector growth in GDP and inflation metrics that would give the sectors on the cyclical side in the EFA index better relative earnings growth than what we could get in the S&P and the big weighting that is in technology. The second factor would have to be if the high level of optimism for the earnings outlook for the tech titans doesn't live up to expectations. Most likely for that to occur, we'd have to have a recession to fall into a place. And we just don't see that happening in the near term.
Thank you for that information, Tom. The tech rally continues to drive the market and grab headlines, but people are also worried about a bubble. For your core equity strategy, you've long had a digital revolution theme that you've emphasized. What are your sustainability and how are you positioning portfolios?
Yeah, no, great, timely question. So first, let's take a look back on history. So what this chart illustrates is that foundational technology breakthroughs have led to periods of time whereby investors see tremendous growth opportunities and gravitate to these companies that are best positioned. So today, the tech titans do represent about 35% of the market capitalization of the S&P 500. In the 1960s, a strong economy coincided with revolutionary breakthroughs, such as, well, a revolution at the time, mainframes and copiers, which created tremendous productivity enhancements and explosive growth in revenues and earnings and stock prices for companies such as IBM, AT&T, Xerox. Now, during the 90s, the combination of fast economic growth, again, being there, combined with breakthrough technologies such as graphical user interfaces, routers, software compression, fiber optics, all of it came together, and it led to the commercialization of the internet and surges in revenues, earnings, and stock prices for companies such as Microsoft, Cisco, and Intel, and a couple of others that weren't so lucky that no longer exist, such as Northern Telecom and AOL. Now, the embracement of cloud computing by corporations and the embracement of social media and e-commerce by consumers in the mid part of the 2010s has led to exceptional growth for many of today's leaders: Microsoft, Apple, Amazon, Google, stocks that we own and love. Now, this trend was further accelerated during the pandemic, which led to behavioral changes, working from home, spending more time in the home. That also led to an additional surge in spending by both consumers and corporations. So here we stand, 35% of the S&P is in the top 10 stocks. Most of them are the tech titans, the Magnificent Seven, as they're sometimes called. So the key question is, how long is this paradigm going to last? Will it end abruptly in the 1990s, or will it take some time to unwind as it did in the Nifty 50 era? So let's dive into some of the key components to answer that question. So this slide shows a comparison of the current situation to the dot-com era. There were both have been similarities and differences. There are a lot of similarities. Both periods have had long economic expansions. The percent of spending on IT as a percent of GDP was increasing, as Paul showed in his slides. And so great economic backdrop. There were truly exciting breakthrough technologies. Today, the convergence of advancements in general processing technologies, large language models, neural nets, and new data architectures has produced breakthrough in computing that can truly rival human brain power. It's been a long time coming, but it is here. Now, there was also plenty of hype in both those areas. The most recent, perhaps, the comment that for AI to achieve its potential, there's going to have to be $7 trillion invested in the semiconductor industry right now, will remain to be seen. But a lot of hype during both eras. Now, there are also some differences that we have to consider on this situation. So in the 1990s, there was an abundance of IPOs, most of which were companies that were unprofitable, didn't really deserve to go public, and hundreds of companies came public every year between 1995 and 2000. Today, while the flood of IPOs is much lower and aftermarket activity is much less pronounced, recent moves by Reddit notwithstanding, there are other signs of speculation in the technology sector, as you can see by the surge in the Bitcoin ETFs. So while the irrational exuberance that was described in the dot-com era doesn't, on the surface, appears to be created, there are some similarities, but there are also some differences. One of which is valuations that I'll dive into in a moment. But let's also take a look at the regulatory environment, because that's very important. So back in the mid to late 90s, the government was so supportive of the emerging internet. We had the Telecommunications Act of 1996. We had the Global Information Infrastructure Framework that was developed in 1997. All of these were designed to incubate and support the fledgling technology internet industry in many, many ways, and basically clear the path of the successes that Amazon, Apple, Google, and the company formerly known as Facebook enjoy today. Now, today, fast forward, because of the dominance of these tech titans, rightfully so, there's concerns about privacy, there's concerns about antitrust issues, there's concerns about the nefarious fake news potential that artificial intelligence, generative AI, can have. So the regulators are increasingly focusing on regulating the industry instead of, as they were in the 1990s, of incubating. Other differences and potential risks outside of the regulatory front is that the deglobalization trends that are occurring and the trade wars, right? Our geopolitical dial still is red. That there could be something that could negatively impact the access to necessary infrastructure advances that will be needed for AI to achieve its growth potential over the long term. Now, let's dive into one other compare and contrast versus the dot-com era. This slide shows an overlay of the dot-com era during the current period of time. So as you can see, up until 2023, there was a long period of time where this era was highly, highly correlated to the dot-com era. It was over 80% correlated. Now, in 2023, early 2023, the correlations began to break down. As you can see by that light blue line, started to move up. Fortunately, it moved up and didn't follow it down. So three factors behind the disconnect in the correlation. Firstly, the stronger than expected economy, driven by the pandemic stimulus that did not lead to the recession that virtually everybody on the planet was looking for. When you look at a yield curve, leading indicators, the 5% increase in the Fed funds rate that historically would have pointed to a recession in 2023. So the consumer strength offset those trends, and so the recession didn't happen. Second reason why the disconnect has happened is Microsoft's pivot to generative AI. It's a $10 billion investment in OpenAI, the creator of the ChatGPT app, and its declaration of war against Google to enter the search market. And all that led to a massive clash of the titans. Everyone wants to compete against each other, and the massive increase in spending that we've seen. Third reason for the disconnect and the difference is that the combined trend of inflows into ETFs, right? This is a very ETF-centric market. So those bigger companies that are in the indexes get a lot of the inflows. That wasn't around back then. Now, we've also seen a tenfold increase in the last 3 years of equity derivative trading, most of which is short-term in nature and has also supported the market concentration. So some similarities and differences that are continuing. The other way that I look at it to try to gauge risk is, okay, what what is going on with the valuations? What's the differences between now and then, not only on valuation, but on the fundamentals? So this slide shows that, yes, the market weights the concentration, as you can see on the far left side, it is very high, but there are important differences in the center. Firstly, these top 10 stocks, they're much more profitable. Their net income, their return on equity is significantly higher than the top 10 stocks back in the day. Also, valuation is not nearly as stretched as it was back then. The top 10 stocks back then, 52 times earnings. Right now, the top 10 stocks are relatively reasonable at 25 times earnings. So this measure would suggest, despite all those, and the breakdown in the correlations, this measure would suggest that this concentrated position can continue for some time. Now, the primary risk to this observation is centered on the potential of an exogenous shock or a resurgence of inflation, some recession, or the fact that the Fed is not going to be able to cut rates. That could have an influence too. But just taking a look at the fundamentals and the valuation, things are not overly excessive at this point. Now, I've been analyzing and investing tech stocks since Microsoft went public. The dot-com era, the ride-up was a lot of fun. Fortunately, I avoided a lot of the pain on the way down. What I've observed over these many years is that successful long-term investing, which is very different than short-term trading, requires a paradigm to evaluate foundational technologies. As you can see, there have been many fads over the years, non-fungible tokens, SPACs, plant-based foods. There's also been a lot of underachievers that we've seen: driverless cars, 3D printing, virtual reality, just to name a few. But there have been several foundational technologies, such as the internet, smartphone, cloud computing, video streaming software, a good list. Generative AI does have the same potential. That these systems have the capabilities to process data at the same speed as the human brain is truly amazing. Additionally, the fact that, as we show on the bottom here, the investments in AI that's expected to increase over these coming years is substantial. And I find it encouraging that the US is leading the way on spending. Our best and brightest tech companies are leading the way, and that's a good thing. That's going to allow us to maintain our 4 Ps advantage. So the big question in my mind is, how big is this opportunity going to be, and over what time period is it going to be achieved? So this is an S-curve. If you haven't seen it before, it's commonly used in technology to gauge penetration of total addressable market opportunity over time. Foundational technologies can create exceptional growth. So what we show here is the typical S-curve that did occur for smartphones and the internet. Took maybe 10 to 12 years for it to unfold. But because it was so substantial, a lot of growth happened. There's also a lot of similarities in these S-curves. So you'll notice on the bottom left part of the chart, what happens first is that you need to build the infrastructure. So back in the internet, you had to build the infrastructure, routers. Today, companies are building aggressively to have the data center, the graphical processing units in place, to have the infrastructure in place to capitalize on the opportunity. Also, applications will grow in sophistication over time. What we're seeing right now is, some very impressive breakthrough technologies, but there's going to be even more to come over the next 3, 5, 7 years. Now, there are bottlenecks. The availability of these powerful chips that cost a lot of money, that could be an inhibitor. The data centers require applications and churn up a lot of power requirements. They need water. And as we've seen recently with the launch of Gemini by Google, the lower retention rates that the people who try Chat GPT tend to move off it pretty quickly. So there could be fits and starts as it comes in shifting from the early stage applications up into the next generation ones. So We're keeping our eyes on Microsoft and their Copilot to see how that launch goes and I'm viewing it as a critical milestone that I think will shape the slope of the curve. The other challenge here is the size of the market. Now, while gauging the market potential for the internet or the smartphones, it was pretty easy to do the math and see that over time, penetration levels of 50, 60, 70% of homes passed or individuals that would want to use a phone would occur. Certainly with cloud computing, as the total cost of ownership came down and it fell below in-house computing costs, an embracement of that happened. With ChatGPT, with generative AI, it's a little more tricky coming up with the size of the market, and because of the potential issues with next generation apps and et cetera, it's going to be sizable, but the shape of the S-curve is likely to be different from what they've seen in the past. So shifting over to core equities, so a foundational element in our core equity strategy has been the focus on secular themes for some time now. The digital revolution names have been a significant portion, as well as others, healthcare innovators, and other strong secular themes. And we're staying focused on those themes. We're staying focused on high quality companies selling at reasonable prices. And as you can see on the right side, using our proprietary quality ranking, core equity strategy compared to the S&P 500 has a significant advantage on a quality perspective. Now, while the performance of quality stocks versus the market can, vary from year to year, outperforming and then underperforming, over time, history shows that quality stocks outperform lower quality stocks. Last slide for me on this topic. So with the positioning that we have in the digital revolution theme, there's a couple of different approaches that we have. There's two levels. The first level is those companies that are clearly positioned in the sweet spot, in the growth in the infrastructure, in the growth of the application side of the S-curve. So for example, if Microsoft or Google or Amazon, which we all want to invest in their data centers, they need NVIDIA chips. And if you need NVIDIA chips, they have to be produced by advanced lithography from advanced semiconductor. We also have investments, what I believe are important second derivatives, as I call it. So Train, for example, provides the highest level of air purification systems that go into semiconductor plants and data centers. Quanta Services provides services to upgrade the electricity grid. These power-hungry data centers, all this AI investment is going to put stresses on the transmission system. So Quanta Services is a great second derivative play. The stock's done well for us and continue to have high hopes for it. So add it all up together, Reagan, I think we've got the right blend of level one stocks, second derivatives. We'll see how this S-curve transpires over time, but I think it's a good opportunity and we're nicely positioned for it.
Thank you so much, Tom. That was very enlightening. David, I want to turn the next section over to you. Equity income, the asset class, is off to a good start this year. Can you tell us about your views of the asset class and what proactive steps you've been taking in the portfolio?
Sure. Thank you, Reagan. Yeah, I'll take you through why we think equity income is attractive today, some thoughts on its benefits and how it stacks up against other alternatives like fixed income, and how we've been adjusting our positioning in recent months for the latest in the evolving outlook. First, at the asset level, and especially after the relative performance gap last year, we see dividend stocks as attractive on both an absolute and relative basis. In the chart on the left, we see that despite participating in the most recent and ongoing rally, dividend stocks remain at, we determine to be an attractive level, below their historic average. The forward multiple is about 12 times running on average, very much a value multiple. And thinking in terms of risk and reward, as we like to do, valuations have much less to fall should we see a turn for the worse, and much more to climb if the macroeconomic climate drives improvement in the operating environment. On the right side, we see how dividend stock valuation compares to that of the broader market. At 21 times, the broader market looks quite expensive, and perhaps more importantly, its spread versus dividend stocks, dividend stock valuations remains at a historic gap. Put simply, if and when we see these relative valuations converge, and that convergence can result from one going up and the other going down, or they're moving in the same direction at different rates, if we see them reconverge to be more aligned as they were historically, that would represent some very meaningful dividend stock outperformance. Another way to approach the question is what benefits do our attractive dividend stocks provide, and what would make them come back or more into favor. And one of the benefits of portfolios of dividend stocks, even portfolios of dividend stocks with attractive yields above 4%, such as ours, is that dividend payments, portfolio income grows. That's a hedge against inflation. And over the last 10 years, income growth from the attractive dividend growth stock universe, attractive dividend yield universe, has more than double the rate of inflation, up 7% on average, versus less than 3% for the inflation rate. And that 7% growth in dividend income also speaks to the compounding value of the portfolio as well. In any case, should inflation remain elevated, we see this characteristic as an important benefit of dividend stocks, certainly for those interested in income, and a potential driver of dividend stock flows once again. To continue on the subject of rates and relative attractiveness, investment grade bonds are a place investors have migrated to over the last year. For the first time since the great financial crisis, investment grade bonds have been returning a higher yield than dividend stocks over an extended time frame. But I'll make a few observations. It does make sense that when we see a transition from dividend stocks yielding a premium to their yielding a discount, that we see some flows from equity income to fixed income for investors that need income. There are a number of variables here, of course, but should rates come down, we can expect this dynamic to potentially reverse, leading to flows back from investment grade towards dividend stocks. Second, as we just discussed, equity income is not fixed income. Its income grows, so it does provide that hedge against inflation. And also, equity income provides equity appreciation. And what does that mean? Well, it's not as simple as comparing yield for yield. In addition to providing good, consistent income, dividend stocks also provide equity returns over time. So for those investors looking for more than just income, it provides the opportunity for meaningful capital appreciation, which serves as another hedge against inflation for the value of the portfolio. And finally, if rates are about to decline, and we share the market view that the Fed will start to cut rates in coming months, we may be about to see this significant headwind of rising rates turn into a significant tailwind. And even if the 10-year were merely to remain stable, that would represent the absence of this headwind that has helped pressure dividend stocks over the last couple of years. And while we believe there's value in the asset class, we also construct our portfolio to maximize our success compared to it, and have been proactive in adjusting to the changing environment. Consistent with how we manage across equities at City National, for all the reasons Tom discussed, we continue to maintain a relative quality advantage versus our dividend stock universe. That hasn't changed and that won't change. We continue to press on our quality advantage, and given we're working with dividend stocks, we also focus on dividend quality. The number one way value gets destroyed within the attractive dividend universe is dividend cuts. We use all our tools, quantitative scoring, fundamental work, years of experience focusing on high dividend companies to avoid the cuts, and we continue to have a lot of success there. We also believe that company size, relative company size, or market cap, is another marker of quality. We've been in an environment of rising or high rates for a few years now, and we shifted towards biasing dividend growth over dividend yield, all else equal, ahead of rates bottoming a couple of years back. That helps us with our hedge against inflation, and it's a relative advantage in terms of the portfolio's attractiveness. And given the uncertain environment, one where the macro picture seems to be improving, but the market environment valuation looks extended, we've been reducing risk in recent months, which has taken the form of lowering tracking error, moderating what had been a modest defensive tilt to be much closer to neutral, and reducing individual sector and position over and underweights. Let's take a look at what that means for our positioning. In general, when we select stocks for the benchmark, we are focused on, for the strategy, we're focused on quality and companies that will survive and thrive over the course of the cycle. Our work emphasizes cash flow resiliency to give us sufficient confidence of a margin of safety as downside protection within the attractive dividend stock universe. The biggest sectors are financials and utilities, which combine to more than half the universe. Within the strategy, therefore, we have material exposure, but we are underweight both of these sectors. Utilities, because we see better opportunities elsewhere at this point in the cycle, despite utilities' low relative valuations. And as for financials, most of that underweight comes from the banking industry. While we do hold a number of banks, we've remained underweight banks since the turmoil of a year ago, and our holdings are larger and more defensive. In terms of overweights, we are overweight REITs, which we juxtapose against utilities as an income sector, but one that may be better positioned to outperform at this point in the cycle. And we're overweight tech, a mix of hardware and software, also based on how we view the cycle, with sectors like hard drives and PCs appearing to be bottoming. And then energy, which we've been overweight a few years now to good effect, and a sector that continues to trade at attractive valuations while returning substantial cash to shareholders. Finally, I've listed some of our holdings across a few sectors to give a sense of the types of companies we're invested in. Durable franchises with competitive advantages from scale to brand to expertise, reasonable valuations relative to their history and certainly relative to the broader market. Companies that have been returning cash to shareholders through buying back shares, and of course, dividend payments and dividend growth over an extended period of time. The companies listed here all happen to be dividend aristocrats. They're among the 67 companies that have increased their dividends for at least 25 consecutive years, although being one of those is not a requirement for inclusion in the portfolio. The last thing I'll leave you with on this is that these companies are representative of the fact that the portfolio consists of quality companies diversified across cyclical and defensive sectors, and then have elements of both offense and defense. IBM, certainly cyclical overall, but also with a large, growing, and resilient software model. Coca-Cola, which participates in both at-home and on-premise beverage occasions, and all executing well with capable management, taking advantage of their competitive strengths.
Thank you, David. That's great information. Tom, we're going to circle back to you on asset allocation. Since last fall, CNR has gotten more constructive on the outlook of U.S. equities. Can you give us a summary of our current positions and thoughts?
Yeah, so several factors, Reagan. As you said, we've had increased confidence in the economic growth as 2023 unfolded, as we were seeing that the consumer was really holding up stronger than history would have suggested, and the risks of recession were coming down, combined with the downward glide path of inflation. So the risks have reduced quite a bit since last fall. So if you look on the far right, I think this chart illustrates the reasons behind our pivot. So when one looks at the center there, the columns that show recession, that typically if the Fed is cutting because of a recession, stocks don't do well. Even if the Fed's cutting, they can decline 11, 12, 14% in the 3 to 12 months after the first cut by the Fed. Now, because we reduce the probability of recessions and increase the probability of better growth, what is more instructive as we see it is the returns in a normalization process, right? The Fed's not dealing with a recession. The Fed's not responding to an emergency situation in the economy. If it's, Russian ruble, long-term capital, 1987 stock market crash types of things, that if the Fed's cutting rates just because they raised rates to slow the economy, to slow inflation, whatever the reasons, that normalization regime, the returns there are better. They're 4, 9, 13% after the first cuts start coming. So we're still of the mindset of 2 to 3 cuts, as Paul said. So the outlook, because of that, has been improved, and this pivot from recession into we're not going to have it has been one of the foundational aspects to a more constructive view as we have towards equities. Now, this slide highlights some of the reasons why we think mid and small cap stocks have become more attractive. As you can see on the right side, the PE multiples of S&P stocks compared to their larger cap brethren is the lowest it's been in 20 years. So a reversion to the mean in the small cap, similar to a potential reversion to the mean in David stocks, could help narrow the gap and create some relative outperformance. The other reason why we find them more attractive is that they have a greater exposure to the US economy as compared to their larger cap stocks that tend to be more multinational in nature. And if we are correct in our interest rate outlook, and rates not going up much, greater stability in interest rates as we're seeing so far this year, that's going to be a positive to mid-small cap stocks, positive to the equity income stocks too. The mid-small cap stocks do tend to outperform in a more stable interest rate backdrop. And lastly, the earnings revision trends. So far, the bigger cap stocks have been having better revision trends, mainly because of the tech titans doing so well. But their growth rates are probably going to slow going forward. And the relative earnings growth for the mid-small cap stocks looks like it's bottomed out. It could start to get better going forward. Remember that mid-small cap stocks tend to have fewer shares outstanding, so the upside potential is greater. Think of it this way. I like the outdoors, so if I go to Dick's Sporting Goods, I spend $1 at Dick's Sporting Goods, 5 cents drops down to the bottom line. That 5 cents only gets amortized over a couple of 100 million shares. If I go to Walmart, spend the same dollar, maybe 2 cents drops down to the bottom line, and it gets amortized over billions of shares. So the relative earnings impact from smaller cap stocks is a better one. This underperformance has been pretty substantial over the last 20 years. The relative underperformance these last few years is one of the most severe over the last 20 years. So with this better backdrop for the economy, growth continuing into 2025, then I think these small cap stocks have a good chance to outperform. I'm very much encouraged by the outperformance of these smaller cap stocks and the equally weighted S&P 500 in the last month. That's showing the market is healthier, there's better breadth out there, and we're not just solely concentrated on the top 10. So to wrap it up, today we've spent a lot of time, a deep dive on equities. Last month we did fixed income, this month equities. Hopefully it provides some greater perspective to everyone on our approaches, our key issues that are going to influence returns going forward. As this slide shows, if you look on the right side, the green part, equities play a very, very important role in our asset allocation framework as we intelligently personalize portfolios to help clients achieve their goals. So for those clients seeking seeking capital appreciation, growth of their capital to achieve their goals, and where volatility is a secondary attribute, we are recommending a high exposure to our U.S. core equity strategy and other percentages to mid-small cap stocks, as well as equity income. As we said earlier, we're continuing to avoid non-U.S. stocks. We continue to look there, but just don't see a strong secular framework for us. As you move to the left, the equity percentages decline, and for those clients who maybe don't need as much upside, don't want as much volatility, maybe they have a little more income requirements, we have the solutions in place to help client achieve those goals. And I think this structure is the right one for the market at hand. So with that, Reagan, I'll turn it back to you for Q&A.
Thank you, Tom. A quick reminder that if you have a question, you can submit it in the Q&A console. We're there, so we'll go ahead and get started with those. Paul, the first question is going to be for you. With the collapse of the Francis Scott Key Bridge in Baltimore, how do you see this impacting the already strained supply chain network and the overall economic impact?
Yeah, that's an interesting question. So disheartening watching how that bridge just crumbles. But it's also an example of how we've seen global trade transform many economies and how it's picked up so much in the last few decades. For example, that ship, the Dolly, that can hold up to about 10,000 containers. If you go back to the 1970s, before global trade was a big issue, container ships only carried around 2,500 containers, about 1/4 that amount. And the Dolly is nowhere near the biggest one out there. The biggest, it carries 25,000 containers. But as we saw with the Suez Canal, where the container ship ran aground, that stuff can quickly cause bottlenecks that will slow down the process severely. So we're reminded that it is quite fragile, and that simple things like an accident or running aground can change or have a big impact on global trade logistics. But it's not just that. We also see this in other parts of transportation, with bottlenecks at ports. Geopolitical tensions are very, very high, which, can lead to such things as terrorist attacks or wars, and that can have a big impact. Trade disputes, natural disasters. Fortunately, this one is not as big as with the Suez Canal. Baltimore is the 17th largest port in the United States. It's a big importer of cars, especially Mercedes-Benz and Mazdas, but inventory is quite high and they will be diverted to other ports. Georgia has one that's been ramping up in terms of trying to get more cars imported there. So that will be helpful. But they're a big exporter of high quality beans that are used around the world. So more specifically, soybeans. So that will have some of an impact. But again, a lot of that can be diverted to other ports like Norfolk. So it's a reminder of how fragile things are. The economic impact doesn't appear as though it's going to be very great, or the inflationary impact. But yes, it is a very fragile system as we're dealing with an awful lot of global trade out there.
Thank you, Paul. The next question is going to go to David. David, there were the vacancy rates in office space, and if that is a concern, can you answer that?
Sure. The short answer is no, certainly not as it concerns our REIT overweight, which I think was the highlight of the question. We don't own and haven't owned for at least a decade any material office REIT exposure. Our REIT exposure is mainly industrial warehouses and triple net retail. There have been long-term secular issues within office, the office space now enhanced by the experience of the last few years, and now it's confronting cyclical issues that are compounding those issues, the impact of higher rates. Where we do look very closely and evaluate our CRE exposure is actually in financials, and particularly banks. And as I mentioned in banks, we are underweight. CRE exposure is a big part of that, and we're focused on banks with the lowest exposures that are most reserved against those, and that have the most diversification of the larger entities that for which it should be the least problematic.
Thank you so much, David. Tom, markets have been on a tear since October lows. What are your thoughts on the outlook over the coming months?
Yeah, they have been on a tear, haven't they? It's been almost one for the record book since the October low. The market has just barely had any pullbacks. Yeah, I think it's due to a couple of factors. One, the downward glide path of inflation, bumps along the road notwithstanding, has led to the prospects for the Fed to be cutting rates. It wasn't going to be 7 as the market thought initially, but they are likely to be cutting rates. So that factor has been a strong tailwind. The strong economy has been a good tailwind. We are seeing signs of speculative behavior out there for sure. The run up in cryptocurrency type assets, the surges in some of these other stocks is a sign that we're probably overripe for a pullback. On a positioning basis, this move is in the top 10% of the history. The positioning from some of the algorithmic traders that are out there that can have very big influences on markets on the way up and on the way down is also a very high. But what could lead to the shift in the momentum isn't clearly evident. So now we are coming to the end of what is usually the seasonally strong period for the stock market, from October up into the March, April timeframe, right? There's that sell in May and go away. So we're coming out of the end of the usual seasonally strong period. So that factor may come into place. Some of the things I'm keeping my eyes on relates to the Treasury's changes in their quantitative tightening approach, the decline in reverse repos that have been occurring throughout the system. Could there be a hiccup along the way there? That could be a potential risk to markets. The economic activity, we are expecting it to slow in the first part of the year. So maybe some of the enthusiasm about earnings, which were helped in the fourth quarter because there was a lot of seasonal strength in earnings. Maybe the first quarter earnings season gives people to pause. So I think markets are overdue. So that's part of the reason why when we've increased our optimism, we're only at a reference kind of neutral equity from a risk profile perspective. Now, keep in mind we intelligently personalize portfolios, so it's hard to draw across the board conclusions, but we're just kind of neutral at this point in time. So that's one way we're controlling risks, making sure we're not overly exposed, making sure we're staying focused on the high quality companies, because if the markets were to get volatile, the lesser quality companies are going to go down more. So historically, this year should be a good year. We came into the year with a mid to high total return kind of expectations. We got there pretty quickly. And history shows that generally presidential years are a good one. They tend to start out strong and then decline going into the election season. So not rushing out to buy stocks, but looking to be opportunistic. And those mid small cap stocks are of interest to us, as I highlighted. Back to you, Reagan.
Thank you so much, Tom. We've got time for one last question. And Paul, this one's going to be directed to you. Is the increase in the expansion of debt level more of a long-term concern, or is this something that could cause a slowdown in the market short term?
It's more of a long-term concern. Federal debt, when you compare it against GDP, is getting close to what the record levels were when World War II ended. But it's a different scenario that we have in Washington compared to history. In the past, whenever the debt to GDP expanded at a quick pace, it was usually because of a war or because of a severe economic catastrophe, like the Great Depression. But following that, it would shrink back down to a much smaller number. But since the 1980s, it's continued to expand. So it's becoming a severe problem. Powell talked about this at his most recent meeting with Congress. He talked about how the deficit, which is the annual amount, is growing at a much faster pace than the economy is, and that's just not sustainable. But this upcoming election, pretty much has two populists running against each other. So my guess is it's not something that'll be worked on much in the next 4 years or so. But investors are starting to get worried because there's just so much U.S. debt that's out there, and it's getting more and more difficult to finance. The long-term economic issue is the fact that as you have more debt and the demand doesn't increase as much, then the yield goes up, and that just makes it a far more attractive investment that people will buy instead of investing in the economy. So it's a crowding out effect, they call it. And that's the long-term concern that we have.
Thank you. Thank you to David, Paul, and Tom as our presenters today, and we appreciate all of you joining us as well. A brief survey will pop up shortly in your console, so please share your feedback and suggestions for future topics. Additionally, a replay of this session will be available within 24 hours, and you will receive an email letting you know how to access it. Thank you and have a great day.